Solana did not win an exclusive institutional mandate this week. It did something more durable. It kept making the shortlist wherever serious financial infrastructure was being built. A sovereign wealth-backed private market strategy launched on Solana and two other networks. A rollout for tokenized commercial bank deposits added Solana as one of the settlement rails. Enterprise payment infrastructure tied the network to firms including Western Union and Robinhood. And inside the protocol, a newly accepted fee design moved Solana closer to connecting network usage with validator revenue and SOL burn. Today is July 24th, and Solana's most important signal is no longer hype, it's qualification. This week's Solana story came down to four forces. Protocol economics moved forward, institutional tokenization expanded, enterprise payment and rails gained traction, and regulated investment products continued turning SOL into an asset traditional investors can understand and hold. The market response remained restrained, but the infrastructure position strengthened. Solana is becoming easier to deploy, easier to evaluate, and easier to package inside conventional portfolios. At the time this report was assembled, SOL traded near $78 and remained slightly lower across the previous 7 days. That matters because the news flow was substantially stronger than the price action. Solana gained institutional exposure across tokenized funds, bank deposits, enterprise payments, and staking-based investment products without producing an immediate breakout. The market recognized the developments, but it did not assign them a large short-term premium. That creates a familiar gap between infrastructure progress and token confirmation. Regulated SOL investment products have already accumulated approximately $904 million in assets under management. The latest daily flow reading was slightly negative, but the size of that outflow is negligible relative to the existing asset base. The wrapper market is established. Demand is simply uneven rather than consistently accelerating. That distinction matters. SOL does not need uninterrupted daily inflows to demonstrate institutional relevance. It needs growing access, durable assets under management, and investment products that continue improving their mechanics. This week advanced the mechanics. The price now needs sustained demand before the market structure can move from restrained participation into broader expansion. Solana's supply profile remains one of its most important structural advantages. Approximately 427 million SOL was actively staked in the last surface snapshot. That represented roughly 73% of circulating supply. Staked SOL is not permanently removed from the market, but it is economically committed to network security. That reduces the amount of supply immediately available for trading compared with the headline circulating number. At the same time, approximately 8.5% of SOL supply remained on exchanges. That is enough inventory to support institutional execution, market making, hedging, and tactical selling. It also means the current structure should not be described as a supply squeeze. The picture is tighter than circulating supply suggests, but liquid inventory remains available. One 30-day metric showed almost $300 million in apparent net SOL inflows to Binance. That figure requires caution. Glassnode updated its Solana exchange labels shortly before the reporting window, so part of the apparent change may reflect improved address attribution or reclassification rather than new deposits. A defensible conclusion is therefore limited. A large share of SOL remains staked, exchange liquidity remains meaningful, and the available flow data does not yet show a decisive accumulation or distribution regime. That leaves SOL positioned for sharper movement if demand accelerates, but with enough evidence to claim that expansion has already begun. The strongest development came from Mubadala Capital and KAIO. Mubadala Capital is connected to one of the world's largest sovereign investment institutions. This week, tokenized access to one of its private market strategies went live across Solana, Base, and SWI. Reported figures differed depending on whether the measurement referred to commitments, total on-chain assets, or deployed assets under management. The available numbers place the strategy between approximately $65 million and $75 million, reflecting those different measurement bases rather than one confirmed total. According to CoinDesk, Coinbase also took exposure on its own balance sheet. For Solana, the exact number matters less than the selection process. A serious private markets product needed blockchain distribution rails. Solana qualified as one of them. That does not mean Solana captured the product exclusively. It means institutional developers considered the network suitable for regulated asset distribution along other major environments. The second layer involved tokenized money. Layer 0 and KETA announced a rollout designed to move tokenized commercial bank deposits across Solana, Ethereum, Base, and KETA. Tokenized deposits are different from ordinary stablecoins. They represent commercial bank money issued and managed inside a regulated banking relationship. Adding Solana to that architecture places the network inside a discussion involving cash management, settlement, treasury options, and the movement of regulated money across blockchain systems. The third layer involved distribution. Cross-mint Solana infrastructure supports stablecoin and payment applications connected to firms including Western Union, Robinhood Wallet, Tala, WireX, and Paga. MoneyGram has also expanded its broader blockchain infrastructure, including through its role as a Solana validator. Taken together, these developments cover three parts of a financial system. Mubadala represents tokenized investment assets, KETA represents tokenized commercial money, Crossmint and MoneyGram represent payment distribution and settlement infrastructure. None of these developments belong exclusively to Solana. That's precisely why the pattern carries weight. Institutional systems will not operate on one universal blockchain that will use multiple networks based on cost, speed, liquidity, compliance requirements, application design, and access to counterparties. Solana does not need to eliminate every competing network. It needs to remain one of the systems institutions repeatedly choose when real products move from planning into deployment. And this week, it did. The protocol story supports the institutional one. Solana's latest engineering changelog confirmed the acceptance of the resource and inclusion fees proposal. Under the accepted design, 2,500 lamports from the base fee would go to the validator, while an additional component based on requested compute resources would be burned. That creates a clearer economic relationship between network demand and SOL. Validators receive compensation for processing activity. Compute-insensitive usage contributes to token burn. As network activity expands, the economic effects become more visible inside the protocol itself. The design has been accepted, but acceptance is not full implementation. The market still needs evidence that the fee system operates as intended, that applications generate sustained compute demand, and that the resulting burn becomes economically meaningful. The development cadence around the proposal is also important. New versions of Agave, Firedancer, Frankendancer, developer testing tools, and software development kits continued shipping. A bug bounty program is being prepared ahead of the planned transition towards Alpenglow. Solana is moving beyond a single client architecture and preparing for a major consensus era upgrade. The network also published analysis suggesting that Brent-exempt account requirements could potentially be reduced without creating an immediate state growth problem. Lower account costs would matter most for applications that create and manage a large number of user accounts, particularly payment products. That connects the technical roadmap directly to the institutional story. Lower onboarding costs improve product economics. Multiple validator clients improve operational resilience. Beef reform creates a clear relationship between activity and SOL economics. The market is no longer being asked to value transaction capacity on its own. It is being asked to evaluate whether Solana can convert that capacity into reliable infrastructure and measurable economic demand. Solana now faces 3 confirmation tests. The first is implementation. The accepted fee structure must move from proposal into live operation. Investors then need measurable data showing validator compensation, compute-related burn, and the relationship between network usage and SOL economics. The second is institutional volume. Multi-chain inclusion is valuable, but participation alone is not enough. The Mubadala product needs assets and transactions on Solana. Tokenized bank deposits need settlement activity. Enterprise payment rails need recurring volume. The question is no longer whether Solana can appear in the announcement. The question is how much activity ultimately runs through the network. The third test is investment access. Grayscale's Solana staking product is moving toward regular cash distributions from staking-derived proceeds. If implemented as described, shareholders could receive distributions at least quarterly. That translates a crypto-native yield mechanism into something familiar to traditional investors. Instead of independently selecting validators, managing custody, and handling staking rewards, an investor can hold a regulated product and potentially receive cash distributions. That makes SOL easier to evaluate as a productive asset rather than a token held only for price appreciation. Of course, several risks remain. Solana's historical reliability record still appears in institutional product disclosures. Validator geography deserves continued scrutiny. Multi-chain products may generate activity on competing networks, and technical proposals create no economic value until they are implemented and used. These risks do not erase this week's progress, however. They define what must happen next. Solana has moved beyond asking institutions to believe that the network might become useful. It is now being included in live financial products, payment systems, and regulated investment structures. Being shortlisted is not the finish line, but assets rarely become deeply institutional before they become usable, measurable, and investable. Solana is moving through those gates. Understanding a week like this requires separating network adoption from token value capture. A blockchain can win integrations without its token capturing the full economics. It can also build value quietly before price reflects the underlying progress. That, of course, is one of the core frameworks inside Understanding Crypto, a clear guide for new investors. The book explains how infrastructure, capital flows, token economics, regulation, and market behavior connect so you can evaluate developments like these without relying on hype. The link is in the description. Subscribe to CoinOps for institutional crypto analysis, full market breakdowns, and the signals shaping digital assets before they become consensus. Then tell me which confirmation matters most for Solana here. The implementation of the new fee structure, measurable institutional activity on the network, or recurring cash distributions from Sol staking products. Your perspective helps shape what I cover next, so stay locked.